The internet forms part of almost every facet of our everyday lives, and the way we access it has become predominantly mobile. Financial services is no different. Firms engage with their clients on a 24/7 basis via mobile technology. Not only are firms bringing products and services to market that are more personalized, but new technology has also changed their internal operations. This is increasing efficiency across the entire value chain, as well as lowering costs in certain areas. As financial services look to the future of innovation, many are also enhancing their operations through advances in data processing and analysis, DLT, AI, cloud-based systems, IoT, and Web 3.0 applications. Luxembourg offers the ideal location for fintech firms looking to expand their product offering among finance firms. This is due to the unique position it occupies as a global hub for private and corporate banking, fund structuring, client servicing, insurance, and payments. A true B2B fintech ecosystem. Beyond this, the Grand Duchy also offers fintech firms a platform from which to offer their services across the European single market. The most successful path forward for bringing true innovation to financial services is through cooperation between incumbents and fintechs. Luxembourg is at the heart of this.
Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Well, ladies and gentlemen, thank you for joining us today for this live stream focusing on crypto and tokenization. Crypto markets have been in a state of tumult since the collapse of FTX in November 2022, while over here on the other side of the Atlantic in Europe, we have the emergence of the world's first regulatory regime relating to crypto assets, the EU's MiCA, which has finally brought these asset classes under regulatory oversight. Focusing solely, however, on crypto really distracts from the bigger picture, namely the potential offerings that derive from DLT technology itself. DLT has a wide range of applications in financial services, particularly in the field of securities services, where we are already seeing use cases come to fruition around digital assets, digital tokenization and security tokens. These developments offer the possibility for creating new classes of tradable assets, or at the very least, dramatically simplifying processes related to existing ones. An example of the potential of this technology came from a report by City GPS in March, where in their report they state that the real-world assets use case is one of the killer use cases for blockchain, and forecasted that there will be around $4 to $5 trillion in tokenized digital securities by 2030. Predicting that sort of level of growth really shows how far familiarity with DLT has come, particularly with respect to financial services. So here we are now, 14 years on from Satoshi Nakamoto's first Bitcoin transaction back around the Great Financial Crisis. And by the time of Citi's prediction in 2030, DLT technology will be about 21 years old. Is the technology finally coming of age? Today's session will explore this topic with expert views, both from the crypto industry, from legal practitioners, and from financial professionals. So let's get started. Well, we're going to begin the live stream today with a discussion around crypto, and I'm delighted for this purpose to welcome Jack Ehlers to the studio. Jack is GM of Bitstamp Europe and has spent a long time developing alternatives to traditional financial services in e-money, alternative payment methods and crypto-based payments, both within Bitstamp and through a variety of very major payments institutions. It's great to have you in the studio today.
Thanks for having me.
So, as we've alluded to in the title of this section, Jack, the markets for crypto have been fairly turbulent, shall we say, over the last year, particularly since the collapse of FTX in November 2022. over on the other side of here in Europe, we've obviously also seen MiCA coming into force, which is the kind of first regulatory regime for crypto. How have the dynamics been changing over the past year from your perspective as Bitstamp, and how have crypto institutions like yours been adapting to those changes?
Thanks, Chris. Well, the institutional trading business definitely isn't dead, but I think it's probably on life support, coming out of FTX. It was a very difficult situation for most in the industry, not just institutions, but retail investors. And since that happened in November, I think what's been on the minds of institutional investors that were active in crypto was, are they willing to accept the risks around the industry that may be maybe less mature than it is in traditional finance? So many of the questions that we take from institutional investors is counterparty risk, about how do we manage our crypto with a centralized exchange like Bitstamp and others? How do they manage also the fiat that we have with them? So these are questions really that they have good answers for in the traditional finance world, and it's really being developed in the crypto exchange. So for institutions, they're also looking for the same things they get in traditional on crypto. It might be post-trade settlement, it might be some other credit facilities, but we're finding that the institutions are thinking, if we're going to be part of crypto, maybe we need to change the way that we were doing it before FTX. Should we have our own custody solution, which is very demanding, but some are contemplating that. Should we just wait and see? And we've seen many of the market makers and other proprietary traders, institutions, just pull out, and in the U.S. especially, but in other markets. So people are reassessing sort of where they are from an institutional perspective for crypto.
Okay, and maybe as a follow-up to that, do you see there as being quite substantially different needs perhaps between those kind of retail, but obviously lots of the focus on crypto is on the retail side of the spectrum, but are there different needs and sort of different dynamics, shall we say, around the institutional versus the retail play?
Well, it's true that the institutional investors, I group them in a couple ways. One is the traders and the investors. So they both have a little bit of a different approach to what they're trying to achieve. On the trader side, they might be asking a lot more questions around the technical performance and the platform, right, that they're connecting into. And that would be one. Again, as I mentioned before, counterparty risk and how they're managing fiat and crypto flows. One of the services this last year that have been developed is off-exchange settlement network. And so we have companies that are developing that. So if you're an institutional investor, you don't expose yourself to holding custody on the exchange. You just move it to a different party. You move it to the custodian. So there are differences in technology, some of the traditional financial services, and also pricing is another, on the trading side for institutions and traders and institutions, the trading side pricing is also something that is top of mind for them. And then the second part is for those investors, do they buy, have they really developed the investment case for their customers, or their clients on why we should buy and hold at this time, the kind of investment strategy. I think that's still something they're working through.
Okay, that's really interesting, and it sounds like they're looking at it in a far more, shall we say, deep and well thought out manner than potentially was previously the case. Also interesting to see that discussion around custody coming through as being an important topic. Bitstamp is obviously a centralised exchange with a physical presence in Europe and elsewhere around the world. But over the last couple of years, a big trend in the crypto space has obviously also been DeFi, or decentralised protocols that essentially do the exchange function without a kind of centralised entity. Maybe you could talk through how you can compare and contrast those two approaches and where you think the kind of future lies. I mean, is it going to be a one-to-one replacement, or are they two going to coexist? And as I say, particularly as we for the topic of today, focusing on that kind of institutional element, perhaps.
Yeah, it's an interesting area. If I started with retail, I think decentralized finance as a service is sort of not ready for prime time. There's still a lot to be done in terms of how a retail investor sort of interacts with it, the user experience. So they're, let's say, maybe not as demanding as the institutional investor side. So I think it's even less developed for retail. For institutional investors, they're looking again, for a lot of what they expect on the centralized exchange in terms of control, meeting the same AML or sanctions kind of requirements of a decentralized exchange. These same expectations or obligations that they have and where they put their crypto, where they make their trade, where they put their fiat, is something that they can't ignore. And it's still in the nascent stages, right? The really early stages of developing that on decentralized finance. So, in a nutshell, I would say that the centralized exchanges really mirror what we see in traditional. Institutions are more comfortable with that and trading on that. But there is that opportunity of sort of eliminating that middle layer in decentralized finance and more direct. That definitely has promise.
Well, thank you very much for coming in today and sharing those insights. I think that it's very clear to see that there's still quite a lot of progress to be made, but it's interesting to see the institutional kind of pace picking up in terms of the knowledge that they have there.
Thank you, Chris.
Well, now we're moving away from the crypto side and towards the more securities services side of DLT, where there has been lots of interesting developments in recent months, including the issuance of digital native bonds, such as that of the EIB, which we'll probably hear referenced throughout multiple of the sections that follow. For this particular part of the programme, I'm delighted to welcome Steve Jacoby, who is partner at Clifford Chance here in Luxembourg, to talk about the legal background for these developments. It's a pleasure to have you in the studio today.
Thank you, Chris.
Maybe just to kick off, the title of this session is the DLT pilot regime and the Luxembourg blockchain laws. So maybe you could set the scene first on how these fit together in the kind of interplay between the member state laws and the EU regulations.
Thanks, Chris. Well, let me first say that the DLT pilot regime is probably obviously the most important thing for DLT financial instruments. There is another piece of EU legislation I know you're going to talk about in other sessions, which is the markets in crypto asset regulation, which is for all of those crypto assets which do not qualify as financial instruments within the meaning of the existing and current legislation, and which regulates these crypto assets, the issuers thereof, the issuance thereof, and the service providers in relation to that. So for the digital assets, which are financial instruments within the meaning of the existing legislation, so largely MiFID. So think the equivalents of shares, bonds, fund units, other types of securities, etc., within the existing legislation. For those types of financial instruments, the EU created a DLT pilot regime, which is intended to create the possibility to create DLT market infrastructure. So really market infrastructure, so trading and settlement of DLT financial instruments, which are really specialized for that. And the idea of the pilot regime is to overcome certain obstacles in the existing legislation that were identified, and to allow operators to, in a way, operate these venues on a test basis in a pilot regime. So you'd ask me, what do member states' laws still have to do with this? Well, actually, quite a lot, because, and without becoming too legalistic, the rules for issuance of financial instruments, the rules that apply in company law, the rules also for the transfer, how you create property rights, how you create collateral over these instruments, are still governed by the national laws of the member states. And therefore, these are obviously quite important. So the national civil, commercial and company laws are still very much relevant to the way that markets and market operators use these instruments. And these actually are quite different from member states to member states. There's been a level of harmonization through some of the instruments like the Company Law Directives or the Financial Collateral Directive or Settlement Finality Directive, but ultimately they do remain different to a degree because they reflect the historic evolution of the legal systems of each of the member states. Now, as part of the evolution of DLT, some of the member states have started adapting their legislation. So among the first ones were France and then Luxembourg and Germany. More recently, Spain, Italy, others are working on this as well. So there is sort of changes happening there to adapt to the new DLT financial instruments.
Mm-hmm. You mentioned there that Luxembourg has already made some adjustments to its sort of domestic legal framework, and I think, if I remember correctly, that started back in 2019. So perhaps you can talk us through some of the changes that we've made here in Luxembourg and their impact.
Yeah, so over the last years there have been three laws, which the market refers to as blockchain 1, 2 and 3. So before looking at what changes these three laws brought, I wanted to sort of show four, I think, common elements which are important to understand also the approach that the Luxembourg legislator took. The first element is an element of continuity. By continuity, I mean that the Luxembourg legislator didn't adopt a completely new purpose-made law, but rather adapted some of the existing legislation in all of the important areas, issuance, custody, settlement, etc., to the DLT requirements, which brings a certain level of stability and also builds on the recognition of these laws both in Luxembourg and outside of Luxembourg. The second element is one of legal certainty, and that's really the objective that the legislator was pursuing, is to create an environment in which operators can use DLT in its various instances of the capital markets process with as high a degree as legal certainty as the Luxembourg legislator can provide by dealing with, first of all, acknowledging the existence of the technology and the ability to use the technology for the different processes, but also by dealing with some of the issues that could arise either because of the distributed nature or in a cross-border context, to the extent it could resolve it. The third element, which I think is important, is it's a legislation, because it builds on the existing legislation, is also legislation that continues to build on intermediaries, on service providers. And that's, I think, is different to some of the initial thoughts around what blockchain would do, which is to disintermediate the market and also disrupt some of the existing framework. And while that may be the case in some areas, I think where the Luxembourg legislation comes in is really to build on the existing ecosystem of intermediaries and allow them to use, with a degree of legal certainty, DLT in these various instances. So this doesn't mean that a disintermediated model isn't possible, but I think we're seeing now a dynamic based on these laws where really institutional operators are coming in to use the possibilities that these laws create. And I think that creates an interesting dynamic in terms of looking for efficiencies around cost, speed of settlement, etc. And the last element is one of neutrality, technology neutrality. And again, the legislator was quite careful to introduce DLT as a technology which isn't related to a specific type of technology, but to really sort of open up the possibility for technological evolution, but also an evolution of the use cases.
Why do you think Luxembourg adopted this approach of modifying the existing laws rather than coming up with some sort of bespoke framework for DLT securities?
So I think the important thing for Luxembourg and for the Luxembourg legislator was to build on the existing legislation, which has obviously worked and is recognized in Luxembourg, but also outside of Luxembourg as a piece of legislation that allows these capital markets processes to operate. The other thing is that Luxembourg always had a tradition of being open to foreign securities, foreign issuers, and to make sure that its legislation was built in such a way that it allowed foreign securities to be accepted in Luxembourg, foreign issuers to operate in Luxembourg, etc. And that's, I think, normal given the structure of the Luxembourg financial market and generally the international reach that Luxembourg has through its financial center. And this openness to sort of foreign securities we find again in the blockchain law. So there is an openness to non-Luxembourg issuers who wish to use Luxembourg law for their debt securities. If they have them governed by Luxembourg law, they can use Luxembourg law to issue their native digital securities. We have non-Luxembourg operators who can, under certain limits and circumstances, use also the possibilities to create securities under Luxembourg law as native digital securities. And we see use cases being developed around the use of DLT for custody and settlement, again, not only for native digital securities, but also for standard securities, as well as using DLT for the issuance. And finally, I should mention that the Luxembourg Stock Exchange has also created the possibility for securities token to be using the securities official list, which means no opposition to trading, but a certain level of recognition of those securities tokens also by the Luxembourg Stock Exchange. So all of these use cases are now being tested on this sort of open basis.
Yeah, I think that point around the culture of internationalism in financial services in Luxembourg is really key. Maybe you could then talk to us about how this is actually being used in practice. Are there particular types of securities you think that work better for the regime here in Luxembourg than others?
So I think, apart for the custody systems, it's actually quite an open system, as I said. So these are being used really for the full range, could be used for the full range of securities, from classic securities to digital native securities, from classic transfers to securities financing operations. We know that some operators are looking at collateral management and how you can use DLT for the purposes of creating more efficiency in collateral management. And finally, you mentioned them already, issuances under Luxembourg law as well. Now, with these issuances, for the moment, there is a limitation because they are done as private placements rather than publicly issued securities, and that has to do with the legal framework. With the DLT pilot regime becoming operationalized, this may change in the future. But even for the moment, with this limitation, it still shows that there is a developing ecosystem in Luxembourg, which really is sort of based on this legislation that allows operators in capital market processes to really use DLT in a number of different instances.
And I know this is obviously a hard question, but looking forwards, what do you see as the next steps, both here domestically in Luxembourg, but then also perhaps at the EU level?
Yeah. So indeed a difficult question, but I think on the national level, we have now seen with these three legislations a comprehensive legal framework being put in place, which now is being used and will need to be used more. As these usage cases are developing, we might see instances where there is a need to maybe change certain things or adapt certain things. We've seen other legislators in other member states do similar things after a certain period of application of the laws. But I think for the moment, certainly we feel that we have all the tools that we need to use these laws. Implementation of the markets in crypto assets regulation is going to be an important topic, obviously, not directly related to this, but that will be something that will take a bit longer now as the process has started, and we will see also things developing there. On the EU level, an important element is going to be the reports that ESMA is going to produce under the DLT pilot regime. So they're producing regular reports, and this is all leading up to a report that the Commission will have to do in 3 years' time in order to establish whether the regime has worked, whether it needs to change, what elements may be required in addition. The last topic, I would say, and that is currently a very much debated and discussed topic, is CBDCs, so central bank digital currencies. Again, these can be quite important. Now, there's a lot of talk about retail digital euros, but when you look at the wholesale side of digital euros, so the use of a digital CBDC, digital euro, in the context of settlement processes, etc., together with settlement of securities under using DLT, that could be a very important element of development as well. But we'll have to see what the next months and years will bring. I think it is clear to me that in Luxembourg we have developed a very good and comprehensive legal framework, and I'm sure the Luxembourg legislator is going to make sure that we stay in this sort of spirit of innovation in order to foster the use of DLT and similar technologies in the future in Luxembourg.
Well, sounds like interesting legislative times ahead. Steve, thank you so much for coming in today and sharing your insights. I think the themes that you're highlighting are definitely going to be picked up throughout the rest of the live stream. So thank you very much.
Thank you, Chris. Thank you.
Well, we're now going to see how some of those legal topics that we've just discussed with Steve translate into actual practice when it comes to digital assets for issuers. And I'm delighted now to be joined in the studio by two experts who are going to talk to me on this topic. The first is Biba Homsy, who is founder and partner at Homsy Legal, which is a blockchain and crypto specialized law firm. She set up this firm following a stint at FINMA and various positions as Chief Compliance Officer at major financial institutions. I'm also delighted to be joined by Guglielmo Manzoni, who's the Head of Depositary and Fiduciary Services at HSBC Continental Europe Luxembourg branch. He's been at HSBC since 2016, focusing on that field of depository and fiduciary services, following a long history at major other financial institutions in Luxembourg operating in the custody space. It's a pleasure to have both of you with us today.
Thank you.
So maybe to kick off on this topic, Guglielmo, HSBC recently provided the infrastructure for a digital bond issuance together with the EIB. Maybe you can talk us through some of the considerations you had for establishing the platform and what your experience has been with that platform so far.
Yeah. So in February this year, February 2023, we launched Orion. Orion is a HSBC digital platform for the issuance, settlement, and servicing of tokenized assets. And we launched it with an issuance of digital native bonds for the European Investment Bank. The platform leverages blockchain technology with a single source of truth on a private, permissioned chain acting as a legal title, legal record of holdings. Transactions occur by exchanging bond tokens and settlement tokens, achieving the digital delivery versus payment within a trusted and secured environment. There is also an additional public permissionless network to which Orion may be connected that represents an information source only with no legal value. It is optional at the request of clients to see transactions in digital bonds. To date, tokenized issuances have been fairly limited. The technology is there, but in many countries, the law needs to be updated to support the transfer of tokenized assets. The key requirement here is that token transfer must be title transfer. In this respect, legal certainty is really vital. As we said, our platform is located in Luxembourg. Obviously, HSBC operates in a very large number of locations, so we are often asked why in Luxembourg. Well, the answer to this is very simple. We just think that Luxembourg has a very good law in digital assets. What we found in Luxembourg, and I think there is a lesson here for all other jurisdictions, is an excellent dedicated blockchain regime. And there's been several stages to it, with blockchain number 1 in 2019, blockchain number 2 in 2021, blockchain number 3, last step, in 2023. And what all these laws mean, just in a nutshell, very, very shortly, is that in Luxembourg you can obtain a regulatory status called CAK, Central Account Keeper. And if you are a Central Account Keeper, you can operate a digital platform like Orion and issue bond tokens for issuers and transfer them to and between market participants that come in and access the platform via custody relationship with the CAK. So all this has been key for the decision to operate Orion out of Luxembourg, and we are very proud that Orion is the first CAK and digital asset platform in Luxembourg.
Great. Maybe Biba, turning to you for a minute. Does the tokenization or the DLT native security, like the one that Guglielmo is describing here, does that have an impact on the rights and obligations of issuers? Is there something that issuers need to kind of bear in mind when they're thinking about issuing these kind of tokens?
I think we already spoke about the fact that Luxembourg thought about changing its laws each time. First for the circulation, actually, of the securities, then the issuance, then the collateral. You had also in March 2023, so just 1 month after the platform, the introduction of the pilot regime, which helps also to create and adapt some of the rights and obligations of the issuer. However, I think that most of the time you hear that tokenized securities and securities token are to be treated the same way. And while I agree, there are common rights and obligations, typically linked to the security itself. You also have some rights and obligations or legal constraints or legal concerns that you need to think about the token itself. Typically the IP, the IT, the distribution, the licensing. These are things that actually are on top and that none of the data privacy as well, by the way, that are on top and that the issuer do not think because they think about MiFID, for instance, and they will not take it as a whole. So I think it's smarter in some way to actually comes from a native token instead of tokenizing and doing the mirroring, because by doing mirroring, you have some kind of complexities. And in addition of that, you have relationship with the traditional players because of your security that is a usual security. And then you add additional relationship with the issuer, the platform, the tokenization platform, the potential custodian, the traditional custodian, the digital custodian as a generic term. So yes, you have rights and obligations that are not per se one-one, that you need to take into consideration. And I think this is key, actually.
Okay, so security tokens and tokenized securities are not exactly the same thing, and it's worth paying really close attention to what precisely you're doing in these circumstances. Guglielmo, coming back to you, what advantages do you see DLT platforms such as the one you've launched bringing to the issuers, and also what impact do you see it having on the sort of intermediation framework that's established for traditional assets? I mean, are certain intermediaries essentially rendered obsolete by the introduction of platforms such as yours?
Okay. So there are multiple advantages and benefits that DLT tokenization can bring to intermediaries and securities markets, such as, for example, the removal of duplicative processes, increased visibility, transparency on holding of securities with a single source of truth shared by market participants, shorter settlement cycles for primary and secondary market transactions, so with near real-time execution, or as they say, near atomic settlement, lower transaction costs, considerable savings for issuers of tokenized securities, substantial reduction of reconciliation breaks as everyone is plugged to the same data source, reductions of barriers to entry for investors through fractionalization. That's why we believe that DLT tokenization complement and expand custody and asset servicing capabilities rather than disrupting the system. We see DLT tokenization as an evolution that will enable intermediaries to fulfill the role in a more efficient way, bringing them substantial advantages rather than render them obsolete. In fact, with Orion, we do not disintermediate. As we said, market participants come in and access the platform via custody relationship with the CIK, so that it's easy for intermediaries to access the platform without a digital platform, without to develop themselves IT digital solutions. What we believe will be key for the success of digital platforms is their liquidity. Digital platform will be successful if they are liquid. This is all about liquidity, and for liquidity you need secondary market transactions. We done them with the EIB bond in Orion, adding new custodians, participants to the platform, adding new markets and currencies, including digital currencies like CBDCs, when they are available, safe and reliable, and we are ready for it. Adding new features like collateral and repo support, which is possible thanks to the blockchain number 3 with the amendment of the collateral law, and exploring trading venues capability and looking at token interoperability between HSBC platform and platform of other banks or ICDCs. So indeed, a lot of exciting things in the digital assets space for the months and years to come.
Biba, do you see this as being essentially a technology upgrade and a wholesale replacement of the kind of existing sort of securities framework for issuance, or do you think that the two will coexist for some time to come? Can you see areas where there might be conflicts or complements between the two different modes, basically?
That's actually very funny because I'm going to concur exactly what have just been said, because I think there are key points that are already addressed. The efficiency, the settlement, and I, as well, don't see it as something that is going to erase one for the other, but more complementary. However, I think there are pain points. And one of the pain points, and that was interesting actually to see the slides, because on the slides you said settlement token. And I think this is typically one of the pain points, because what kind of settlement token? Yeah. Are you talking about a deposit token on a wholesale bank? Are you talking about central banks, currency? Which currency, in which area? We heard as well about HSBC platform, and 5 days ago, there was actually an announcement for another bank's platforms with BlackRock as well. So things are moving very fast, but there are still pain points. The settlement token, I think, is one. The interoperability about wholesale banks' platforms, and also, to be honest, tokenized platform service provider, I mean, that are not banks, but are providing service in terms of tokenization outside the remit of a credit institution. Cybersecurity. It's a focus of all the regulators, and that's also something that is interesting. And what is actually missing, to be honest, but it's because we are at the very beginning, it's a common standard. And that is something that needs to be also addressed. I believe we are a lot speaking about the Euro digital that is coming, which is good, the different platforms, but I think we need to have also common standards on how interoperating this platform works.
So issues really around fragmentation, liquidity, and we need something like a SWIFT essentially for these platforms, so that liquidity and securities can essentially move from one to the other relatively straightforwardly, right? Yeah. Biba, perhaps continuing with you and talking about that topic of investor protection, particularly looking at the custody layer, because of the particular way in which these digital tokenized assets are recorded, there's probably a substantial difference in terms of how the custody works. And from a legal and compliance standpoint, how are investors' rights actually safeguarded on something like a DLT platform, and how is that different from a traditional approach with a custodian bank?
So as I said before, the law is more or less the same. We are speaking about MiFID, so typically treat your investor honestly, fairly, transparently, remain the same. Okay, this is the basic. Then you need to do the differentiation between whether it's financial instruments, because we've been speaking about financial instruments. We've been talking about tokenization of financial instruments or having a financial instruments in a token. And for this applicability, it's the same. The rules apply the same. The only thing is about whether you consider the DLT as a mean where you can keep the token. But the protection, the reflection about how to safeguard the asset, how to ensure the property, how to transfer are the same. I'm of course speaking under your practical view, but from my experience at least, it does not change. You don't need to actually reinvent the wheel. You do need to assess it correctly, for sure, and to discuss with the regulator to show your use case. But it's not like completely reinventing. You have depositories, you have potentially custodians for that as well, but it's the same approach.
Guglielmo, as somebody who's kind of been living and breathing custody and depository services for such a long time, perhaps you could also share your wisdom on this topic of, from operationally looking at it, what challenges and opportunities do you see on the custody layer?
Yes. So, in fact, when we talk about digital bonds, we are talking about assets that qualify as financial instruments held in custody. So, as such, the rules, obligation, liabilities relating to such instruments under UCITS and IFMD are exactly the same and will have to be followed and complied with. The difference is that digital bonds will be held by depositories or their delegates in digital securities accounts that are open in a digital platform like Orion, acting as a CIK. And the depository or their delegates will be able to settle transactions relating to digital bonds in such digital securities accounts in a more efficient way. Depository then will reflect digital bonds as custodian for their investment funds in their legacy custody platform, generally in a seamless way. For the rest, segregation, naming convention of digital securities accounts is the same as for traditional securities accounts. Due diligence on the CIK will have to be adapted to consider the different nature of the CIK, so central account keeper versus a traditional sub-custodian. And the same can be said for the legal agreement between the CIK and the depository that will have to take into account the different nature of the CIK. So as far as digital assets qualifying as financial instruments held in custody are concerned, it's more a question of adapting certain elements rather than revamp the traditional depository and custody setups, indeed.
Great. And maybe just to wrap up then, let's look forward five years or so into the future. And what do you think that the issuance landscape will look like once these platforms are a little more, shall we say, mature than they are currently? And how do you think that will? How do you think 5 years down the line there? What do you think that split will look like between traditional issuance and DLT issuance? Maybe we start with Biba and.
So I've been in digital assets since 2015. I feel like a dinosaur, to be honest. And each year, people were saying, next year, it's the year. However, to be honest, and to be very positive, we are seeing a multiple development for platforms, for tokenization platform. There were full standalone tokenization platform. Now there are banks or credit institution driven platform. I mean, I really see a balance between traditional financial instruments and these digital representation, because finally it's the digital representation of a right or a value on the DLT. Again, not one is gonna replace the other. However, I do see an acceleration. I think it's also because, at least from Europe, the signal about the pilot regime, okay, 3 years, but it's a pilot regime, and if it works, then it's going to stay. This is a good signal, and this is how it, also the Luxembourg signal, to be honest. They don't need necessarily for specific under threshold the pilot regime, and Luxembourg understood that and have these 3 laws as well. So I think it's going to develop and have a balanced solution.
Guglielmo, I leave the last words to you then.
I think they will coexist in the short term, but given the advantages of DLT technology, it is reasonable to expect that DLT will take over for some use cases in the medium long term. Good thing, however, is that technology allows the two of them to coexist and can integrate both type of assets and issuances, or traditional assets and digital assets, in a seamless way.
So there you go. There you have it. Not necessarily a wholesale replacement, but certainly an acceleration on the DLT side. And with that, I'd like to thank Biba and Guglielmo for joining me in the studio today. Thank you very much.
Thank you.
Thank you. Thank you.
Well, moving on from that discussion around digital assets for issuers, we're now turning to other elements of the securities lifecycle. And to have this discussion, I'm delighted now to be joined by Scott Lucas, who is Head of Markets DLT for JP Morgan, and he's responsible for the strategy and execution of new trading products built on DLT and blockchain at JPM, and also on wider industry initiatives and market developments related to DLT. Thank you for joining us today, Scott.
Very pleased to be here. Thanks for the invitation.
So as we've heard from others today, there's already some interesting projects being launched around the issuance of tokenized or DLT native securities. But issuance is obviously only one part of the life cycle of the security. And maybe you could talk us through what you're seeing as a result of DLT securities on other elements of the securities life cycle, for example, in trading or brokerage, or perhaps the post-trade arena.
Sure, and yeah, I think when it comes to the broader life cycle, it depends on which bit you want to focus on. So, a lot of people are starting at the back end, post-trade and settlement. And if we take those two pieces, when we really think about settlement, what does blockchain or DLT enable you to do that you don't have in current technologies? I would say that the key word for me is precision of settlement. There's a lot of talk about instantaneous settlement, the ability to execute that trade immediately after the agreement of the trade. I'm not sure that's exactly the right way for existing capital markets to leap into. It feels more like the ability for those settlements to be very precise in their timing and move that mismatch of timing between expectation of delivery and actual delivery, or the movement of securities or cash in either direction. If they're not sort of pure DVP, that is a real area of focus, because that actually takes risk out of the market in that settlement, and allows for that certainty of the receipt of the securities, but then potentially for other onward delivery shortly thereafter. So I think that's an interesting area, the precise nature of how one can settle. That also enables the opportunity for simple things like netting and other capabilities between the trade and the settlement to still exist in some form. So I think that's one really key area. And the other is in the servicing side. And there's quite a lot of complicated servicing components to different types of securities. Probably the simplest example is coupon, and having that straightforward relationship where one can all parties can see the same calculation, which removes any of the requirement, I guess, for multiple groups of multiple parties to check about what that coupon is going to be. Because all of a sudden, if you see the same record and you're both looking at the same source of that record, it's impossible to disagree. And that component then starts to turn around and say, well, actually, if I can't disagree, I don't need all of those people checking. I then don't have that overhead. And enables not just a lower cost base for the servicing, but also it opens the door to other opportunities in the longer run about transparency of that, frequency of that, maybe push the level of sophistication where issuance can reach smaller companies and open capital markets further. So there's quite a lot to unpack in that space. But we're starting usually at the post-trade settlement end, just to realize immediate benefits and then work further up the stack.
I mean, one of the things that we're seeing at the moment is a real proliferation of individual platforms being set up to support issuances of DLT. Do you see that as maybe posing a fragmentation risk for the market and, maybe having an impact therefore on liquidity? And, how do you think that kind of issue could be solved?
I think it certainly does. I mean, it would be great if we could leap to, one global platform that did all cash and security settlements. I think that's an unrealistic expectation for maybe ever, but certainly for a long run. Even creating a single jurisdictional platform is complex. And part of that is around the investment cost and the timing and the use case and the economics. So, I think it's unsurprising that we see individual platforms being created by different institutions. I think the good thing about that is if you federate that cost out, you get both the ability to do something at a cost that's rational for that institution and their clients, and you get people and groups focusing on different areas. So you get a bit more of an R&D culture and what's going to work and what's not going to work. The downside of that, of course, is as something takes, then you need liquidity, and how do you then achieve that? It's a challenging technical problem. It's probably a bigger challenging legal problem, and regulatory problem, but none of them are unsolvable. And so therefore the question really becomes not, can it be done, but how is it done? And so, if you look at the two choices, one is invest a great deal at high cost and great complexity to completely restructure a financial market, and then everyone to switch to it, low probability outcome. Having a set of individual platforms that create something of value and then grow, higher probability outcome, and the problem it does create, I think, is more solvable. So yes, there's challenges, but I think it's a more realistic and pragmatic way to make progress in this space.
Okay, so challenging but manageable. Maybe bringing you back to that point around federated R&D, I know JPM has been doing quite a lot of interesting things in the sort of repo and collateral management space. Maybe you could talk us through some of the initiatives that you're doing there and how they maybe generate benefit for your clients.
Sure, I think it comes back to some of the things I spoke about settlement. We're really focusing on precision. My last role was in running intraday liquidity across the firm, and one of the key areas that we focus on is what is that mismatch in timing and what liquidity do we need to reserve in case that the way the current market infrastructure works fails on a particular day for either technology, operational, idiosyncratic, or market stress reasons. So when you think about that and what that costs the institution, both from just a capital and liquidity, but also just what risk it brings to the market, that focus of precision and faster opportunity for settlement is an area we've looked at, both within our own platforms when we're thinking about accelerating the ability to access liquidity through repurchase agreements or repo agreements. And the traditional market infrastructure does that overnight. We'd like to see a market that does that intraday. And we've done some of that bilaterally with our clients. We'd like to see that grow into a market structure because that's something that the market could resolve. Equally, we've worked with HQLX, clearly, Luxembourg-based company. They mobilize collateral across multiple pools to be able to, again, remove that mismatch in timing and have that speed of execution, which sees, a much better delivery mechanism, a lower risk footprint, and I think, a better liquidity outcome for the clients who are of that platform who are on that. And over time, thinking about interoperability, it's not just doing the R&D and working with our own platform or other platforms to get real things done. It's how do those things come together? And we're actively working on that now to figure out, what clients do on HQLX do with how can we offer that service across multiple institutions and link it to what we're doing in repo? And then what's the next step with the wider market to develop that further? So, that's why I have confidence that we can solve that problem with interoperability. Mm-hmm. We're working on that now. I think, there are multiple jurisdictions where that becomes or is being enabled through active dialogue with regulators and the broader market, Luxembourg being one of them. And so, I have confidence that we'll get there across that. So that's where you see that R&D process, institution by institution, starting to come together to create a little bit of a market impact.
Okay, moving towards coalescence. Maybe just to focus, obviously, on the last in the last panel and then this now, we've been focusing very much on the kind of securities aspect of it. But how much do you think this is likely to remain almost a theoretical exercise, or how much do you think it's going to be blocked without there being an option for having sort of on-chain or DLT-enabled cash for the cash leg of the transaction via something like a CBDC, for example? Do you have any thoughts in that respect?
Yeah, I mean, cash, regardless of the form, cash is fundamental to this. I mean, it's a core component of the outcome of any transaction, regardless of what type it is. The end result is there's a cash, position, whether it be P&L or whether it be actual cash movement. So yeah, of course we need to have more cash on ledger solutions available. There's multiple choices there, and you see different variations of that coming to the market. There's individual bank solutions. Ourselves and others have those individual bank solutions. And it's good to see more and more scale happening there. There's market, I hesitate to say consortia, but sort of collaboration across different platforms, such as Regulated Liability Network or Finality in the UK, where there's other commercial solutions being considered and developed. And of course, there's central bank digital currencies. I think with all of those, there's going to be a reflection of what are people comfortable taking risk over when it comes to not just the trade, but the actual settlement of that. And so therefore, it kind of has to be recognizable. So I do think we need a combination of those things, where we have money that's linked specifically to an institution, so JP Morgan coin, a Citi coin, or whatever, deposit tokens, whatever form they sort of grow into. I think sort of some of these consortia or market platform solutions like Finality or Regulated Liability Network could have a role in connecting specific areas of the market, almost in an FMI type structure that would be recognizable to people today. And then thirdly, central bank money clearly has a role. I think central bank money as a direct liability is probably challenging when you think about the impact on the overall credit cycle, but central bank money is a mechanism of moving cash from one position to another, I think is actually quite fundamental to the long-term success of this. So yeah, it's absolutely required, I think, putting it in a few different forms to make it recognizable, to enable people to take risk. But then again, coming back to how do those fit together across the broader securities market and with each other is one of the challenges we're going to have to work through.
Yeah, so very much, again, a question of quality of money and then how that links into the risk profile of individual people continuing to be an issue also in the DLT world. Well, Scott, thank you very much for joining us today.
Thanks very much for the opportunity, and I appreciate the chance to do that.
And now I'm delighted to hand over to Emilie Allaert, who's the head of the Luxembourg Blockchain Lab, who will be leading a discussion on real-world asset tokenization in 2023 at the edge of a precipice or about to take off.
Thank you, Chris. It's a real pleasure to moderate this panel on real-world asset tokenization today, where we'll have the opportunity to discuss with two experts in the field, Luc Falempin and Nicolas Garcia. The first one is the founder of Tokeny, based in Luxembourg. Welcome here and thanks for joining us. And we have Nick Garcia, who is the founder and CEO of FortunaFi. Thank you very much, guys, for joining us today. I guess we will start by a little bit of a context, and especially the fact that we hear on a regular basis that there is quite a lot going on tokenization, and especially this last few years. In Luxembourg, we see quite a lot of use cases where it has been developed and constitutes a new craze, especially with the introduction of the terminology real-world assets. We already had tokenization in real estate in Luxembourg. Instead of giving you the definition, I want to ask our panelists what is their take on it, and whether they could provide us with some specific elements of understanding. So I will start with Luc. It's the educational minute. Could you please explain in intelligible terms what does tokenization mean?
Sure. So first, thank you for having me. So tokenization is the process to represent assets on the blockchain. So we create digital keys on the blockchain to represent any type of assets, virtual asset or real-world asset now.
Okay, and is there a need for a specific infrastructure to do that, or is it just on any kind of blockchain?
So it can be any kind of blockchains, and there are different technologies for blockchain networks. So over the past years, we've seen a lot of different things: private blockchain, permission blockchain, public blockchains are different categories. But for tokenization, any type of network can be used.
Okay, thanks for this clarification. And Nick, now I would like to have a better understanding of what is the meaning of real-world assets. What does it mean, and what are the use cases?
Yeah, so look, I think, I may be the first to, maybe not the first, but certainly will admit that I think real-world assets is not the best name for this, but lo and behold, it has taken off over the last couple of years. As you've mentioned, Emilie, that, folks used to call this tokenized securities, tokenization. There's folks calling it now off-chain assets. I think, Luc's description is very accurate, right? Ultimately, it's an traditional asset, right? Whether it's a publicly traded asset or a private asset, it sort of fits a lot of different types of assets, but effectively it's a non-native crypto asset that's being represented on-chain through some form of a legal and technical infrastructure that's being implemented in the back end. And really, what's happened over the last couple of years is you've had this proliferation of stablecoins and DeFi and additional layer ones and layer twos that have really opened up the opportunity for users and enterprises and different institutions to create new products on chain with very familiar assets that allow users to get actual more utility from it now that we have sort of this concept of decentralized finance, which is really just financial services on chain in slightly different mechanisms that have more distribution to users globally. But I'm sure we'll get into more of that as well. But yeah, it's effectively off-chain assets tokenized on-chain.
And what is the use cases that you're currently observing and that could make sense, speaking of real-world assets?
Yeah, so, as we've sort of alluded, there was this initial attempt to bring these assets on chain back in 2017, 2018 that ultimately failed. There really wasn't the correct infrastructure. It was really just Ethereum back then. You didn't really have this proliferation of stablecoins and decentralized finance as you do today. And really now coming into the end of 2023, what we're seeing is there's numerous different layer ones and layer twos and numerous different decentralized applications built on those layer ones and layer twos that are looking to drive new use cases and sort of enhanced use cases that they've already been doing. So one of the major assets that have been really picking up steam are US Treasury bills. Naturally, with the existing macro environment, the rate on these T-bills have been very attractive, giving the risk relative to the reward. It's been a very high adoption asset. We've seen stablecoins adopt these as collateral. We've seen users hold these instead of stablecoins. We've seen permissionless trading venues use these as cross-margin collateral. We're seeing a lot of new use cases. A lot of it has started with these T-bills, but it's certainly moving over to additional types of publicly traded assets, right? Asset-backed securities, securitizations. There's a number of different publicly traded assets that are now also being brought on chain, but I think there is going to be sort of a big proliferation of private debt assets as well that are brought on chain to find more efficient sources of liquidity. But certainly T-bills has been the dominating asset this year for sure.
Thanks for this clarification, Nick. What is your take on this, Luc? Do you observe the same thing, or is it a little bit different here in Europe?
Yeah, for sure. On chain, we see more and more T-bills because today it pays you 5% annual yield, and on Aave with your stablecoin you get 3%. So for sure, if you launch some kind of tokenized T-bills, you can attract a lot of people owning stablecoins or crypto who can get in your financial product quite easily without passing through the traditional banking system. So for sure, more and more T-bills. We see some money market funds now, which are quite simple to tokenize, I guess, and very liquid, and that you can use even as stable coins step by step. So it's very interesting. But historically, we've seen a lot of different type of assets. A lot of real estate. Now the market is a bit slowing down on the real estate side, so we see more and more private debt. We always had a lot of funds, different type of funds, open-ended funds, closed-end funds. Technically, you can tokenize anything you want. So then it depends the use case you want to bring to the market.
And Nick, you're based in the US. What is happening there regarding tokenization, especially the fact that there is a discrepancy between the regulatory framework in Europe, in the US? It's not going at the same speed. So what is your observation at the moment?
Yeah, so certainly, I mean, I think it's pretty evident that Europe and sort of other geographies outside of the US are moving substantially quicker than the US. It's pretty evident through the laws that have been put in place, through Luxembourg, Switzerland. I mean, there's more and more locations coming up that are creating effective frameworks for tokenized securities. I think in Europe you're seeing a lot more of a direct tokenization of the underlying, right? So the token represents a ticker in particular, and that's sort of the way that the regulation is being allowed, and sort of that's how it's scaling in Europe from my perspective. In the US, you don't have these new regulations, right? So you have to sort of fit into the existing framework. I do think things will change over the next few years. I think there needs to be some shifts in the government, which I think we're having elections next year, and so we'll hopefully see some improvements there. But we do have the framework of the Investment Act. From there is the private fund section, which has different exemptions, and there are mechanisms to create very scalable forms of tokenized securities through these existing regulations. They're naturally not they're not the most efficient mechanism, right? If I were to say, I think if we were to enable tokenized public funds to exist within a regulatory framework, that would be the next major step, I think, in the US. But for now, the private fund framework certainly works, and we can create transferability using that framework and maintain full regulation and compliance. So I do think the US needs to make a significant amount of improvements. Hopefully we do get some regulations over the coming years that will sort of change that. But there are mechanisms in which we can scale this industry today within the US, and that's one of the things we're focusing on here at FortunaFi. The product that we're launching here very soon is open to both US users and international users that go through KYC, AML, and then they're able to sort of onboard and utilize the product. So it's really trying to think of the product from a global first perspective rather than a US or Europe perspective.
Okay, and I guess as in every industry, especially in the tech environment, there are some limitations or some missing elements that make difficult the adoption. What are at the moment the limitations in the tokenization world? Luc, maybe if you want to start.
So I see different problematics that we still need to solve. The first one is to have the cash leg on chain. Of course, you have some stable coins, but they are not credible enough yet for the banking infrastructure, the financial institutions playing in that field. And the other main area is really this lack of compatibility with the traditional banking system. So basically, if you tokenize, a lot of different players don't know how to handle your tokens, don't know how to distribute them, to collateralize them, to do anything with them, to service them. So this is progressing step by step. Tokens after tokens, you have new players who understand how it works and how they can handle this new digital things. But there's still a long way to go. So I think the stablecoin part can be fixed quite quickly. Now the regulatory landscape is progressing. Even in the US, they are discussing this. So hopefully it will change soon. In Europe, we have MiCA, which is clarifying a bit for stablecoins. Maybe the part that is less clear, but at least it's better than before. So really, we need some large actors tokenizing cash, first for their clients, and then to open the system to others, and it will change drastically the industry, I think.
And what is your take on the fact that we hear that securities are the ones that are tokenized in Europe? In the US, it's pretty much nothing that can be tokenized or that is tokenized. And in Asia, it's pretty much everything. Is it something that you're viewing on a daily basis?
Yes, I think it's true because in Europe, we have a clear understanding now about this new instrument. And basically, if you tokenize securities, they are still securities. So that's quite clear for all players. In Asia, there's still a bit there's differences between RWA, STO. Is it a new thing? Is it the same thing? And securities laws are most of the time a bit less advanced than what we have in Europe. So it's a bit more the Wild West, let's say. And in the US, it's quite difficult because the large players don't know if they can use public blockchains or not. Mostly because they are not really authorized to hold crypto to pay their gas fees or that kind of things. So there are a lot of doubt still in the US to use these public blockchains. So it's true that more and more we have clients in Europe, but historically we made some tokenization projects all around the world. So it's not such an issue when you have the right technology, because you have securities laws and we can enforce all of these laws as regulations on chain. So none of our clients got any issue with that.
And Nick, yes, sorry.
I do want to jump in with some just quick comments there that I think there is some misconception around what's going on in the US right now. So just some data points that I think are helpful. I'm sure most people are familiar with Franklin Templeton, right? They are one of the largest institutions in the world. They happen to be one of the largest issuers of tokenized securities on permissionless blockchains. From my understanding, they currently are issuing on Polygon. They currently have one of the largest TVLs of any issuers, period, on chain. I think it's in the 300 million sort of range. And so, just contrary to what I'm hearing, more broadly, sometimes online, sometimes, in private discussions, but there is quite a bit of activity in the US, right? Despite there not being a new regulatory framework to enable the actual tokenization of the specific securities, there are existing frameworks that can be utilized, which is what I was talking about earlier, specifically the Private Fund Act, which is sort of a subsect of the Investment Act that enables, private funds. There's different exemptions that allow this, but I just do want to point out there are large, very well-known institutions that are already live in the space with size. Pretty much every single other institution, from Citibank to JP Morgan to Bank of America, really across the board, are all looking at this very actively and very close to launching products. A lot of them do have products that are intrabank that are live today. There's quite a bit of volume actually going on the intrabank activity as well, but that is going to scale even more to permissionless blockchains. So I just do want to clarify that there are mechanisms to enable not just US users, but US institutions to tokenize these assets. And there are large players that are already live, such as Franklin Templeton, that are doing this today.
Thanks for giving us your insight on the US way of doing things. And we discussed the fact that tokenization is there for quite a while already, but still RWA is the thing that made it appear quite frankly in the media. We're hearing about it like on a daily basis. Why is there such a craze, in your opinion, Nick? And which need is it filling?
Certainly. So I think, there's a very interesting sort of macro environment going on right now where you're seeing these T-bill rates continuing to go up. You're seeing, existing yields in DeFi, which were historically significantly above the off-chain rates, coming down quite a bit, just as risk comes down and activity comes down and sort of the industry resets again. So you're seeing there's sort of this macro environment where the rates are in fact now higher and there are more attractive scalable products off-chain than on-chain today for yield specifically. But compounding the fact that there is now like a very big ecosystem of protocols. And when I say protocols, I mean, they're effectively tokenized infrastructure, but really businesses, if you will, that are decentralized naturally, but that are producing significant amount of capital. So you're seeing stablecoins like MakerDAO, you're seeing stablecoins like Note, which is live on a blockchain called Canto that are now being backed by T-bills. And this is going to continue to proliferate. Even Frax, which is a pretty large decentralized stablecoin, is now also onboarding T-bills. And so what you're going to get is this revolution of if some of you may have heard of, DeFi Summer, which was an early sort of growth of users and activity in decentralized finance on chain, we believe there's going to be sort of a next phase of that really is using RWA or tokenized securities, whatever you want to call them, as sort of that base collateral within these protocols to start earning a significant amount of yield. So one quick example with the product that we're going live with Canto is you'll be able to, either US or offshore users will be able to mint T-bills directly and onto various different blockchains. But one of these first use cases is enabling, 10 plus leverage on T-bills, right? Which is something that's quite difficult to do. I spoke with a financial advisor that recently helped their client get some leverage against a portfolio of T-bills. I asked them about the rate and the LTV. And, this is a scenario where the client needed to do this for purchasing a home, sort of a big purchase. So it was okay, but it would have been a much more efficient transaction. It would have been a cheaper borrow than the yield on the T-bill, and they would have gotten a much higher LTV. So they would have made a more profitable transaction just simply by being on chain. So I think these use cases are growing, and more it drives new users directly on chain through applications that'll abstract some of the complexity of operating on chain. But ultimately, the benefit here is it drives more value to users directly, which is what will drive these users to sort of come into this ecosystem. It's what we've been seeing pretty actively over the last year.
That brings us to the next question I had for Luc, actually. When we launched the tokenization, and I think you were one of the first in 2017 to launch one of these platforms, I had in mind that it was also to solve the issue of distribution and liquidity of these markets. Is it now an issue that is solved? Is it a problem from the past, or are we still experimenting a little bit of difficulties in these two areas?
I think it's still the end goal, but we're not there yet. Most of our clients, large financial institutions, really benefit from tokenization on the operational side, so to gain, to make efficiency gains, basically, in their operations, to move assets faster and that kind of things. But the distribution and liquidity side is not there yet. Why? Mostly because we are lacking good tokenized assets. The good tokenized assets are just a few. You can count them on your hands for the moment. So we need a massive influx of good assets, regular assets tokenized in a compliant way with the same standard to make sure that this is happening. What we've done is to create this technical standard, open source, and to make sure that a galaxy, a full ecosystem of applications, trading venues, service providers, etc., are compatible with this same standard. So step by step, we are getting there. And now when you tokenize with this standard, indeed, you have, I think it's like 15 centralized exchanges. It's compatible with any DeFi protocol. You have some digital trading desk. So step by step, we're creating this ecosystem. But we need much more tokenized assets in order to create the supply and then the demand and then the supply and then you enter in the virtuous cycle.
That leads to the question as well. We are observing a lot of financial instruments being tokenized and being digital twins. While in the idea of blockchain from the beginning, it was really to create digital natives. Is it like a problem, or is it something that we want to have actually a digital twin of financial instruments, or are we willing to move to something more digital native?
So I'm not sure it's an issue. So most of our customers, indeed, they create digital twin or whatever we call it, but basically the token is not the security itself, it's a proof of ownership. And any movement on the blockchain will be reflected with our tools on the cap table. So at the end, it's the same, except if you natively say my token is my security, it brings a lot of questions. And there are just a few countries in the world where you can do that, and with some constraints. Luxembourg is one of them. But most of the time, it's just a proof of ownership, and therefore you can use it, leverage it with the same conditions without making it a big deal where you need to change all of your contractual agreement with all the investors, the service providers, etc.
Okay, and it's already time for our last question. And this is for both of you, actually. I'm taking the crystal ball on the stage, and I would like us, I think we all agree that RWA tokenization is really something that is about to take off or is taking off. But there are still elements that are missing. So how do you see RWA tokenization in 2 years' time? And I will give first the mic to Nick for this question.
In 2 years' time is an interesting question. And in 10 years' time is an even better question. I think in 2 years' time, we see, currently we're at about 1.4, 1.5 billion. That does change pretty frequently, but in the 1.5 billion range of tokenized RWA, tokenized securities, whatever you want to call it, on chain today. I think in the next 2 years that easily quadruples. And I think that's just really existing adoption of these tokenized assets with the industry today. So a lot of existing users, there are a lot of net new users coming in, but it's really the distribution of being able to use these assets on chain with these different protocols. I think 2 to 10 years out, what you start seeing is these institutions coming in size into the infrastructure that's been built in these first 2 years to provide additional utility for their clients and more efficiency for their internal operations. And so I think these next 2 years are really all about building the infrastructure that's needed to support this massive growth that will likely go from 4 billion to 30 trillion from that 2 to 10 years out, right? So we're talking about absolutely massive scale. This will significantly grow the crypto ecosystem. It's one of the things that are sort of necessary in order to bring this digital ecosystem to the next level. It's obviously not very scalable when you have just internally recursive assets, which is what we had back in 2017, 2018. Bitcoin, ETH, just purely digitally native assets. Now being able to bring in these additional high quality assets that have yield and can be used as the basis of a lot of these different applications on chain today is what really enables this next leg of growth. So I think we go into the 4 billion type of range in the next couple of years, and from there to 10 years out, I think we're going to have like a hyperscale into sort of the 30 billion type of range.
Okay, and Luc, in your mind, what is going on in 2 years' time, and what is the real use cases that you would like to see develop?
I think it will go faster than what we think, because now we have the right blockchain technologies and infrastructure, we have the right token protocols, we have the right providers, and mostly now we have some big names, BlackRock and others, saying we are going. So of course there are large financial institutions, they need time to get organized, etc. But they are already starting. We already work with large banks, asset managers. They are all working actively on this type of projects. So in the next 2 years, yes, they will start tokenizing regularly good assets on public blockchains in a compliant way. So I think it will drastically accelerate the ecosystem. But what I would like to see tokenized in the short term is loans. Why loans? Because you can do thousands of loans. It's usually short term. It's a small tickets. You can divide all of this. So if we have these thousands of loans suddenly on the market, people will start really playing with these tokens, do a lot of things with these tokens, and we will really see the value emerging. So that will be quite fun.
Well, thank you, Luc. Thank you, Nick, for this insightful panel. And now I will hand over to Chris.
Well, thank you, Emilie, Luc, and Nick, for that very fascinating panel and insight into RWA. And all it's left for me to do is to conclude today's event. Today's event has covered quite a wide range of topics, from crypto through digital native securities and all the way through to tokenized and RWA assets. But I think that there are 3 key themes that really stand out to me personally anyway as being unifying factors between all of the discussions. The first being the importance of a clear legal framework to really enable these kind of discussions. The second being what to do about fragmentation and the impact fragmentation has on market liquidity, whether there's potential solutions for this either from a legal framework standard, from industry cooperation, or through the development of some form of standards. And then third, I think it's an interesting time to look at this sector, because it strikes me that there is an increasing nuanced view or increased knowledge about DLT from the TradFi world, but also vice versa. There's an increased interest, thanks to RWA in particular, in traditional assets also from the crypto space. And so with that, all that it's left for me to do is to thank again all of our speakers for participating in today's events. Thank you, our audience, for joining us for today's live stream, and our sponsors for helping us put on this show. You'll be able to find more about our upcoming events on our website, so please check out there, and we hope to see you again soon.